Diversification. The headline says, is it working? Well, I'm going to tell you it always works. Diversification is the cheapest way to protect someone's portfolio. You don't want to have all your eggs in one basket. We've heard that term or that saying for many, many years. However, there are certain points in time, in my opinion, where certain parts of the market, and we've seen it over the last few years, such as technology, have outperformed pretty much everything else. You can make the argument that gold has outperformed tech this year, and that's quite possible, but we'll see what happens by year end. I still believe the price of gold is going to fall, whereas I also believe tech and tech sector is going to surge even further ahead. So technology, part of a diverse portfolio, but at certain times, I believe it is a good idea to perhaps overweight a certain part of the economy, of the markets. And right now, I think if you're an investor that has overweighted slightly technology, or perhaps overweighted that part of the market significantly, you'd be in the driver's seat because technology continues to drive the bus forward. It continues to lead this market further and further ahead. And there is no doubt about that. I know a lot of people have spoken about the S&P 500 equal weight. We talked about this on the show before, but it's technology, make no mistake about it, that has earned a lot more than all the other sectors of the market. The Mag 7, Magnificent 7 stocks, earnings tripled what the other 493 stocks have done in terms of it's gone up over 27%. We have a chart on that in a moment versus the rest of the 493 stocks on the S&P 500. Let's go to our first illustration. This clearly will show you the Nasdaq 100. So these are your biggest tech names, how they fared versus the S&P 500 equal weight, which means if you just took the Nasdaq 100, compared it to an index like the S&P 500, but if the index was equal weighted, right now we know the S&P 500 is overweight tech, but if we equal weighted everything, what would be the difference in growth? And you can see the Nasdaq 100 has significantly outperformed pretty much everything else, including technology, if you equal weighted everything. So this makes the case to overweight technology. Now, once again, you have to be careful because you don't want to have too many eggs in one basket. We have seen points in time where technology has pulled back when the rest of the market hasn't. So it's not like you're immune to all volatility if you own technology, but we all know that this is where the growth is. In our second illustration, we've seen this diagram or chart before on a previous broadcast of our show. But this will show you, there it is, how much the Magnificent 7, just the Mag 7, not even tech as a whole, just the top of the biggest 7 names have outperformed. And you can see here on an earnings per share growth basis for the first quarter, year over year, 27.7% growth versus 9.4% growth. So this is what I mean when I say tech. Now, I know I'm going to get a lot of questions from clients and investors saying, are you saying we should not diversify? No, I am saying you need to still diversify. But there is nothing wrong if you want to overweight certain parts of a portfolio. Perhaps you want to overweight certain names in a portfolio, certain investment ideas in a portfolio. There's nothing wrong with doing that, as long as the rest of your portfolio obviously is nicely diversified. You know, in a market, in certain times, you may want to put a little bit more in an area where you think that it will have outperformance. So I'm not saying not to diversify. All I'm saying is just be mindful of what's working today and what parts of the stock market and what sectors are clearly outperforming the others.